Hi, Michael Landsberg, Chief Investment Officer, Landsberg Private Wealth Management. Welcome to our fourth quarter market update. What we're going to do today is spend a little bit of time just talking about the election, what we saw, what kind of happened, and why the market reaction was as strong as it was, as well as what we think is going to go happen in the next quarter or two as President Trump retakes office and what some of the policies are. The market obviously reacted very violently after the win, pushing stocks to all-time highs. Part of the reason I think you saw that was a lot of the institutional investors that were out there looked and said, hey, we don't know, this is going to be a close race, at least that's what they anticipated, and they bought some puts or they shorted the market in case there was a Harris win. And that was going to basically mitigate some of their downside. What happened was Trump won, and it was a decisive win. I think a lot of folks had bet that, A, if Trump did win, it would be a Thursday, Friday, next week kind of event, kind of what we had happened before with late data coming in. And what happened was, boom, we woke up Wednesday morning and the market was off to the races because it was a decisive win. And so when people institutionally looked at their portfolios, they saw that they were losing money on their shorts. So in order to cover a short, you have to buy stock. So stocks were going up and all these additional buyers came in and pushed stocks to theoretically all-time highs across most major indices. The other thing I think the market reacted to was Trump brings a less regulation bent. That's what he did in the 2016 to 2020 administration. Less regulation oftentimes means things, for example, like mergers may more likely get done. Tech rally because there's going to be less tech regulation. Some of the issues that you've got now has been there's some regulations on tech in terms of deals that theoretically has hampered the values of some tech stocks. Not many tech stocks because tech has done quite well, but we anticipate tech continuing to do well. Another industry we think will do well is financials. In the 2016 administration, banks, regional banks, money center banks did very well during the first Trump term because there was less regulations related to banks and increased lending, increased deals. Banks make a lot of money, investment banks on M&A, mergers and acquisitions, and we think that'll continue, as well as industrials. An area I think that's going to continue to do well is going to be energy. And I say energy in particular is going to be some of the areas as tech does well. What we found has been there's lots of areas that need energy. One of the things that you've seen in the last 3 to 6 months is nuclear energy's kind of come back. And it's one of the few things that both sides of the aisle agree on. I don't think you're going to see some of this clean energy do particularly well in the sense of the solar and wind. I think that stuff's not going to do well. But nuclear, both sides of the aisle agree, is probably a place that we want to continue to see growth and development. It's very safe over time. We all know the big accidents, but for a lot of times it's been very, very safe. But what's interesting has been there's a demand for electricity related to artificial intelligence. These chips and these data centers need a ton of energy. And so when you do a search, for example, on Google, it requires a certain amount, or Bing, it requires a certain amount of power. If you do the same search with your phone on ChatGPT, which is an AI-based website, it takes 10 times the power to do that search. Now, that search is a lot smarter, a lot more depthful in terms of the knowledge, but it requires a lot more power. So what we're seeing is there's going to be demand in these data centers from power. You've seen that with some of the big mega cap tech stocks that have been making deals with nuclear energy companies to basically say, hey, we'll want to put you back online and get the power. We think nuclear is going to continue to do very well in this administration because the power demand is going to be huge. So we think that's going to be an area that's going to be good. Obviously, President Trump ran on the idea of drilling more, which has been interesting because President Biden ran on the idea of ending fossil fuels as we know it, but the irony is the opposite happened. We've done more oil exporting and oil exploration during Biden than probably he would have possibly imagined at the beginning of that term. I think Trump continues that. The difference here is I think we're going to get to a point where more energy ultimately available from U.S. companies is going to keep oil prices relatively low. So that's going to be a positive on the inflation front, as we don't think it's going to go up strictly because of energy prices going higher. We do think inflation made the low in September. We think you're going to see inflation start to creep back higher. Now, I say that, I don't think it's going to 9% again, but I don't think it's going to 2.0 either. I think you're going to see it go north of 3 and maybe make a move towards 3, 3.5. We know if you're watching this video, you know inflation's a lot higher than that in your daily life. That was really the crux of this election. People were telling, the Democrats were often saying, hey, the economy is much better than you think it is. But in reality, many voters said, that sounds really good, but how come my insurance bills are up 10, 20, 30%? And the cost of food was up 10, 20, 30, 40, 50%. And that's really what I think took the election was people's pocketbooks ultimately kind of won out over where they thought they needed to be. I think what we're going to see is you're going to see, I think, some inflationary pressures come back. Now, again, I don't think you're going to see 6, 7, 8%, but I think that 3 to 4% is there. I also think that's going to keep interest rates a little higher. I think you may see one more additional interest rate cut. But I think in reality, what you're going to see is higher rates for longer, higher inflation for longer. And ultimately what that means is our positioning is going to be what are companies and stocks that are going to do better if inflation's a little higher than it is now and interest rates kind of stay here and peak. I think a lot of the market prior to these last couple of Fed meetings thought you're going to get a lot of rate cuts. We don't think you're going to see that. I think the Fed's going to be on hold for much of 2025. And so if companies were banking on that to be able to do better, I don't think you're going to get that. Again, our investments are predicated on what companies earn. At the end of the day, what you earn is going to move your stock price. And so we look at reported earnings, not expectations, but what earnings did you report? And how does that look year over year? Are you accelerating or are you decelerating? And a lot of the companies that we follow are accelerating their earnings. That's a positive. Broadly, the S&P 500 is going to see a high single-digit earnings growth year over year. NASDAQ will be actually double digits again, which is the more tech-heavy indices that's out there. We continue to own NASDAQ. We'll own that as a satellite. We think that's going to continue to do well. Tech is an area that we think will do really well. In the current environment, on the other hand, healthcare, which is going to be some huge reforms coming in. You've got a new appointee, whoever President Trump appoints to be involved in healthcare. We know RFK Jr. is going to be involved. And there's some areas there that some mandatory vaccines and things that may or may not come to pass that get taken off the table from being mandatory. So there's going to be some pressure on healthcare, and that's probably, again, ultimately going to be good for inflation, but probably not great for healthcare stocks. So you'll see, for example, we've been lowering our exposure to healthcare, increasing our exposure to technology, just given the environment that we're in. At the end of the day, what you earn is actually going to be more important than who's president or who's not president. I've talked about that many times. The presidency is one of those things where, okay, depending on who wins, we're going to do well based on if the companies are making money. What we have found is there's going to be some initiatives by this president who doesn't have to run for re-election. So that's a scenario that allows him maybe to do some things a little bit differently than he did the first time that I think may be positive for some sectors a little bit more than we've seen in the past. So I think that's a positive. We're going to be looking for that. Also, we think the dollar continues to get stronger here. Trump is going to be a very more pro-dollar, pro-US, and that means pushing the price of the dollar higher. That's an environment that we think is good for some companies, not good for others. We think there's parts of the world that are going to benefit from our involvement, but all other parts of the world, they're not. I think you're going to see a slash in spending, for example, whether it be NATO, where a lot of people are talking about, we're going to get out of NATO. I don't know if we are or not, but we're currently carrying over 60% of the budget of NATO, one country. So obviously we know that's wrong. Trump has shown the ability to stand up for that and say we're not going to pay more than we're supposed to pay. The irony is we'll use the fair share. We should be paying our fair share, not everybody else's share. And that's realistically what's happened with a lot of the NATO UN stuff. And I likely see our role there being diminished purposely, because I think we're not going to spend that. The goal ultimately is, can we get some spending in control? If spending's under control, that will ultimately be better for stocks. The concern is with both candidates, they're probably going to blow the debt up a little bit. And now with it being Trump the victor, we'll see probably debt increase a bit, at least at the beginning. The goal is, can he be able to cut some costs somewhere else? Again, I don't know if he's going to cut the Department of Education, et cetera, et cetera. Lots of stuff being thrown around. But at the end of the day, if we're looking at excess costs and spending, we should be able to rein that in a bit. And that should be positive for stocks longer term. Again, we think bond yields are going to be a little bit higher. So that's a good thing for us from a money market standpoint. We're still going to get paid on money market. Again, we think commodity prices will slowly tick higher, albeit not as high as they were before, because the dollar is going to be stronger. So when we look at sectors that we're looking at, we think financials will start to do well, a little bit better now that he's won. Industrials will continue to do well. It's been a favorite sector of ours. We also like tech. The stuff, for example, in healthcare, we're probably not as big a fan in healthcare. And again, real estate, with rates being as high as they are, we've kind of soured a little bit on that simply because of where that's been. In terms of globally, we're looking at other areas of the world that continue to deposit money. We've done really well in India for a long time. It's been about an 18-month trade for us, having some sector exposure there in our satellites. You're seeing us lower that exposure simply because it's getting a little bit long in the tooth. We still think India is a great place to invest longer term, but in that short to intermediate term, it may have kind of stalled out. And again, that's the environment that we look at, is that short to intermediate term. We don't really look at the short from a trade standpoint. We look at that as how do we position in the short term for intermediate and longer term gains. So we're willing to take a little bit of short term pain to get intermediate and longer term gains. Those longer gains mean a lot more money. Shorter term pain is way better than longer term pain. So again, if we're gonna have some pain in the positioning, we'd rather take it on the short end and then have a longer run of quarters and years versus having a couple weeks of pain. So that's about where we positioned. You've probably noticed in the last month or two, your statements are probably back to nearly all-time highs as markets have gotten back to all-time highs. That's a positive. We think that continues. Again, do I think 25 is going to be as strong as 24 turned out to be? No. But part of the reason 24 was as strong as it was there was a certain amount of a lack of enthusiasm in the market that drove enthusiasm higher as things were better than expected. I think now a lot of people are maybe anticipating glory days are here again with Trump, and I don't think it's going to be that rosy. I think the market will continue to do well, but I can't imagine a 25 being quite as good as a 24. So with that being said, if you've got some expenses that come up in the next 3 to 6 months, particularly after January 1, it may not hurt you to take a couple bucks off the table if you've got a new car or a trip, a wedding, a graduation, whatever it would be, new boat, whatever it would be. Maybe to take some of that money off the table in the first quarter because we've had such a good run in 23 and specifically into 24. The other thing that I'd mention is in November, which basically it's when we're filming this video, we go through all the portfolios to generate as much as we can in tax losses. 24 has been a great year, not a lot of losses, but we do want to take as many as we can get to be able to lower the tax bill. Ultimately, the goal over time is for you to keep more of your money in the government to get less. And so we do that in November to be able to kind of tidy up the portfolios, make sure there's anything that's at a loss, that we take it. It helps you with your taxes right away. And ultimately, if we do any selling of winners, we try to do that in January, where we don't have to pay taxes for another 15 months. It's some of that planning that we do, because ultimately what we're looking at is clients to make money, but clients to pay as little in taxes as we're legally allowed to do. So we certainly want to be able to do that for you. And you'll see that in the next few weeks as we're doing those transactions to make sure that we've mitigated as much of the tax bill as we possibly can. So again, we think the market here is positioned very well. New administration, I think there's a certain bit of jubilation that this ended fast. If you remember during the 2000 election, Bush v. Gore, we had to go to the Supreme Court, we had the hanging chads. That wasn't a positive for stocks or for bonds when the outcome was hanging. Biden versus Trump, again, not a positive outcome in terms of our standing in the world with certifying the election, not certifying the election, special runoffs, January 6th. Again, not a great time for us in the global standing. This, I think, was a nice kind of way to button up some of this in the past. It was a decisive win. We knew it the next morning. Markets rallied on the fact that A, it was over, and B, we didn't have any of this drawn out where there would be some of this back and forth with the counting and the cheating and some of the stuff that went on in the past. Again, the market likes certainty, and this was certain. So again, I think that's a positive from the standpoint for us to move forward. Again, we think the positioning for next year is going to be a positive year. Just don't know how positive it is. But again, we've had such a good run up. Again, we rebalance our portfolios to make sure we're trimming from some of the winners and making sure that some of the stuff that's underperformed gets a little bit additional money. That's a way that we can manage control of risk. What we don't want to have is more and more money going only into the winners, because over time what happens is we do know that winners have a period of time when they go down. And so we want to have an environment. We just have to go back to July when tech was getting killed to remember that there are times when things are out of favor. So we don't want to have all of our eggs in one basket. We want to have eggs in lots of baskets and keep track of that. So again, we appreciate the opportunity to serve you. We welcome anybody who wants to contact us to reach out to us to do so. Have a happy and healthy holiday season, and we look forward to chatting with you next year.